Yamada everyone, my name is Azra Bandali and I serve as a volunteer on the Aga Khan Economic Planning Board and will be your moderator for tonight. I would like to welcome all of you to this retirement savings webinar. Each year, February is dedicated as the Retirement Savings Month to highlight the need and importance for all of us to actively save for our retirement. This webinar is the first of two national webinars being offered this month. In addition, there are several regional sessions being offered in partnership with our national partners, Charles Schwab, for those Jamaati members who do not currently have a retirement account and would like to start saving for their retirement. Please be on the lookout for more information in your regional Ismaili Insight, which is released every Monday. Before I introduce our speakers for tonight, I would like to cover a few housekeeping items. As a reminder, this webinar will be recorded. The link to this webinar will be sent out in an email along with a survey link. The format of today will last about 75 minutes. We encourage everyone to submit questions in the Q&A chat box. Our presentation will cover the details about the importance of retirement savings, various types of retirement accounts, and investment options. I would like to first introduce the chairman of the Aga Khan Economic Planning Board for the United States, Akbar Poonawala, to give us a few words.
Yalimadad, thank you, Azra. And Yalimadad, everybody, thank you for joining the retirement savings session today, the webinar today by the Economic Planning Board. Wanted to thank you for the time that you've taken on a weekday evening, and wanted to talk a little bit about the outline of the retirement savings plan and the retirement savings plan month, which has been in place for the last 3 years. In many of Maula Bapa's farmans and hidayah, we've heard about his emphasis on quality of life. We've heard about his emphasis on longevity. He talks about the impact of longevity. People are living longer, lifespans are longer. People live to 70, 80, 90 years of age, longer. And the working life is still the same. 60 years, 65 years, 70 years, thereabouts, 75 years. And the earning life is also limited for many Jamaati members and people in general. So if an individual is going to live for 80, 90 years and their earning is limited to the first 65, 70 years or so, it is necessary that we provide for the subsequent years in life. And as we know from many records, many financial reports, that a lot of resources are required in the latter part of life. Either it's for long-term care, health-related expenses, medical care, etc. So we have to prepare for a longer duration of life, for 70, 80, 90 years or in excess thereof, to live, even though we may not be in a position to earn in the latter part of life. So this is where our savings come in, our retirement savings come into play. And this is something where we have to keep one thing in mind, and this is very, very important, that banks will give us a loan for buying a car, buying a home, while we are in our working stage, while we are in our earning stage of life. Once we are retired, nobody is going to give us a loan for retirement. None of the banks will give you a loan for retirement unless it is to do a reverse mortgage, taking equity out of your home. So especially in a country like the US, it is very, very important for us to prepare for our own future, for our own longevity, for our own long life, if we are blessed with that, and to make sure that that second part of life or the latter part of life is a happy one, and the quality of life in that part is a good one. In order for us to make sure that we lead a good quality life, the Imam has underlined, emphasized, and mentioned it a few times that we need to ensure that we have the resources necessary. So essentially what we're trying to do in this webinar today which is intended for business owners, is we're segmenting one part of the Jamaat, the business owners. And this is deliberately focused, this presentation is deliberately focused and targeted towards the business owning segment of the Jamaat. And here we'll talk about the factors as they apply to the business owners. And every February, we've shared with the Imam that we are celebrating February as a retirement savings month. And it is not a one-time endeavor. It is not a one-time effort. It is not enough to just open a retirement savings plan. It is very, very important that we fund that account every year, that we fund our retirement planning, the money grows over a period of time, and it is there when we need it. So please know that this is something which we do report. The National Council does report to Hazrat Imam in the end of term report, and he takes particular interest in knowing the financial condition of the Jamaat as to how are they provided for, how is their quality of life, what is the level of savings, and so on. So he was very pleased to hear in 2019 that we had struck this relationship with Charles Schwab, and we had set up X number of accounts, which allowed the Jamaati members to save for their retirement. So thank you very much for joining this call, this webinar, and I hope that we will all take it very seriously. If you have a retirement savings plan, a 401k, IRA, KEO, etc., that you will fund it, you will continue to fund it every year. And for those who don't have it, you will initiate one. We'd greatly appreciate that. And with that, if you have any questions, you can reach out to our team here or any of the EPB members. So thank you very much and wish you all the very best. Yalimada.
Thank you so much, Chairman Akbar. And to kick things off, I'd like to give a warm welcome to our presentation for today, Roshan Anjani. Roshan is based in Dallas, Texas, and is a certified public accountant and certified financial planner. Thank you for joining us today, Roshan, and I'd like to pass it over to you to kick off our presentation.
Thank you, Azra. Thank you very much, Chairman. Thank you for being here for us. This is very motivational to have the whole leadership of Economic Planning Board being present in this webinar to that speaks by itself. So thank you. I'm going to just start with a disclaimer that this presentation is brought to you by Economic Planning Board. During the presentation, I, as a presenter, will be giving you some opinion. Those opinions will be my own and not representing EPB. This is not a tax advice. This is not a legal advice, because this is for educational purposes. So please consult your tax professional or financial planner if you have any legal questions. But I will try my best to share whatever I can in this presentation. So let's start with a quick story. King was about to announce death sentence to a prisoner person. Before the king could say anything, he stopped him and said, "King, if you just give me 1 year to live, I can teach your horse to speak." So the king took a back and started thinking. And then he said, "Do you really think you can make my horse talk?" He said, "Yes, I can. If I don't, then kill me, after 1 year." So he gives him the chance to go. And while he was walking away with the guard said, "You cannot make the horse, speak. Why did you promise that to king?" He said, "Listen, 1 year is a long time. In 1 year, king may forget, or he may die, or who knows, the horse may start talking." So I'm very glad to be back here, third time in a row. I will not tell you what I told EPB for them to give me a chance again to come and present this webinar for you. But I'm super excited. The content in this presentation are very well put together. I've been in practice for a long time, and I have used all of these, many of this when I was going through it. Very, very helpful. So let's get started. First question comes, as Chairman said, it's very important that we plan for it. More important, sometimes we have this question, and we really need to think, especially people in their 20s and 30s who are joining the workforce and young, and they say, retirement planning now, it's just 40 years from now. Why should we worry? But let's give you some big reasons why you should start thinking yesterday, not today. But if you didn't do it yesterday, if you didn't do it today, do it now as soon as you can. So first, very big one, we all know that everything that we buy today is going to cost more than what we were able to buy for a much cheaper price has gone up in price, right? So look at the chart, how it grows with 4.3% inflation in the last 40 years. Things are 6 times more expensive than it was 40 years back. This is general. Now, if you currently that number, the inflation is about 2%, which is good, but still, when you talk about 1,500 rent, people in New York and California and all those places, they'll say, no, you don't get anything for 1,500. But even with that 2% rate of inflation, 3% inflation rate, we're talking quite a bit of money in the next 25, 35 years. So this is first reason that you should plan, because everything that you buy today will be more expensive. And nobody, we all know the health cost, right? Last 25 years, average increase have been 8.4%. Hopefully that this might be something that we are looking forward, that the healthcare cost should come down. We are with the new administration, but that is another big reason that everything that we will need in our retirement, health things, all are going up. The third important part, Chairman just said that everybody is living longer, right? So you look at the chart. In just this country, 1900, the average age was 47. Fast forward, now we are talking 77. Today the average age is, but if you're today's 65-year-old couple, they have good 18 more years to live on. If a married couple is still alive at 65, they have 18 more years. And what they are saying, that people who are born today, kids who are born today, they have a good 50% chance that they will live beyond 100. Currently, there are about 50,000 100-year-olds. In about 30 years, that number is going to be tenfold. About 500,000 100-year-olds will be in this country. Well, with all that, Social Security, which was there to protect people who didn't plan well, or Social Security net, as we call it, we started with 16 to 1 in 1930. Today, we are down to 3 to 1. 3 people are funding, 1 person is taking it out. Well, guess what that number is? In 30 years, that number is going to be 1 to 1, because there are so many people who will be over 65, and there'll be only that limited number of people who will be funding. So these are the 4 big reasons that we talk about. So these are the reasons why you should, right? So these are problems, alerts, watch out, get up, do it now, let's plan for it. Well, let's talk about some planning. How do we get to this problem? Let's start with the solution, okay? Let's first thing talk about identify your retirement goals. Because first thing you have to do is, a financial planner, somebody comes, they say, I want to retire in 20 years. Well, how much do you need to save to get to where you will retire comfortably, right? So that's the first thing you have to come up with, that number. What do you have, where you are? That's the first thing we need to know. That we have 200,000 saved right now. I'm 44 years old. I've got 30 years to, 25 years to retire. At 69, I want to retire. So that's the first thing you have to know, is how much you have. When do you want to retire? There's another thing, there's a timeline. And then you break it down into, okay, fine. If you want to retire, with what kind of money that you will need in your retirement, that's the next question that you have to ask, what lifestyle you want. And I'm going to give you a simple example to break it down. And this is where gives us a jolt as to how much we need. So think about a couple who spends $5,000 a month. $5,000 a month. That's a very average middle class family, right? So $60,000, and that person comes to me today, would have come this morning, and say, okay, I want to retire. Do I have enough, or what will it take for me to retire with $5,000 monthly expense? Am I 65? Well, without knowing much of it, I'll just give you a simple formula that you take that number, what the person gives, or whatever your needs are, $60,000, multiply that by 25. 5,000 a month times 12, that's yearly expense of 60,000. And then you multiply that by 25. So that gives you about 1.5 million. And this is investable asset, because the goal is that you want to take that investable asset, generate income from it. So in that way, you can pull the money, pay the 4% monthly expense. Some years will be good years, some will be bad years. And your money, the nest egg, doesn't deplete when you go to 85 or 90 or 95. So there's a we call it margin of safety is there, that, hopefully that you want to leave the money to your next generation. So the nest egg gives you that income, continues you in retirement, and you can pass on that money to your next generation without depleting that nest egg. So these are the important things that we ask you, that when you think of retirement, that how much you need, what is your monthly budget, because this is what we're going to give you, where do you stand? Because first thing you need to know where you are, where you want to go, and then you say, okay, this is what I will retire with how long, 20 years, 15 years. So these are the important questions that we need to sit down occasionally, every 2-3 years. Every year is better if you can do that with your family and see where you stand, because this is a long-term journey. We start today. There are so many calculators you can find on Google that you can just plug in those numbers and say, okay, these are my assets. This is the income I can generate from it, and what it's going to take. So this is another thing that we first figure out the plan, the need, what you have, and how many months or years you will take to get to that level, and comfortably pull that money so your nest egg doesn't deplete. Okay, let's break it down a little bit further. So how do we get to that big goal? So I just give you a simple example of a couple who needs $5,000 a month. That's $60,000 a year. You probably need about $1.5 million to start with, so you don't deplete your asset. Now, if somebody says, okay, I need $100,000, then you're talking $2.5 million, right? So how do you get with that big number? Somebody might say, oh, wow, this is a huge number. Let's come up with some solution. People who are in their 20s, 30s, and 40s, spatially. I mean, there's a simple way. There are a lot of tax code benefits that Uncle Sam gives you. If you look at the current population of our country, we have about 8% of the population who are millionaires. And if you look at their assets, the biggest asset that they have beside their home is their retirement accounts. And of course, they have other assets, but biggest chunk of money sitting in their retirement accounts. So because the government has given last 40 years, in 1980 onwards, they have pushed for these retirement accounts where people can fund these retirement accounts and take benefit. And these are the 4 big group of retirement plans, and we're going to explore that. So you understand how you can take advantage of this, how you can build your wealth in a faster way, in an easier way, because this is a long term, especially when you have time, especially for people who are in their 20s, 30s, and 40s. They can really make things happen with very little effort if you plan and if you work. And that's the goal of this presentation is, so there's a 401k, individual retirement accounts, Roth IRA account, self-employed. We're going to talk about those accounts. So most of the time people say, why have you not signed up for 401k? What is this 401k? First of all, we'll define. Well, I never be able to run that far. 401k, we have heard of 5k, 3k, 2k. But 401k, well, that is basically Internal Revenue Code, IRC, Internal Revenue Code section 401k, which talks about 401k and company plans. And there's a cousin of 401k, which is 403b. This for school teachers, hospitals, government employees. They're about the same. They all are becoming pretty much about the same as they used to. They used to be very different, but over the years, they all start looking very same. I'm going to spend some time over here because this is one place, 401k, the concept of it, although this is more for small businesses, but the concept is very, very important because what we have seen in my personal meeting with the Jamaat, that even if you're a business owner, the chances are that one of your spouse is working professionally, they have a 401k, you have business, so all your children are going to be more in companies than 401k. So let's talk about this concept. Very, very powerful. This is going to bring a lot of things, the benefit of 401k, why we are presenting it year after year, making sure Jamaat understands this, because this is extremely, extremely powerful tool the government has given us and which is in place by your employer, which you must need to take benefit of. Okay. So this year, and it was last year the same number didn't change over 20 and 21. Somebody who's under 50 years of age, they can contribute $19,500 per person into their 401k. If you have a company which offers 401k, which is, by the way, now 69% of the companies in the US are offering 401ks with substantial amount of matching. And we're going to talk about that in a minute. So if your company is one of those 69% of the companies, you can get to defer 19,500 into your 401k. If you're over 50, if you turn 50 this year, even if you turn 50 in January or anytime during the year, you get to defer another 6,500 on top of that. So that brings your deferral amount to $26,000. Now, a married couple, both over 50, they can do 26 plus 26, 52,000. And under 50, couple can do 39,000, right, for the year. Now, the second part, that's just the tax deferral amount. But what is more interesting is this second line, which I'm about to tell you, because this is most misunderstood or not followed or ignored by the general public. I know nobody in the Jamaat who's attending have ever done that. They all take part of it. But just to highlight that company matching. If you have a 401k, 69% of the companies are offering with the matching. And the average matching as of 2020, last year, was 4.3% matching, right? Now, this all doesn't sound too exciting to clap and jump, but let me break it down so you understand, especially young professionals who have joined recently, their companies are about to join or should be joining. You understand this concept because this is the best thing can happen. As a CPA, when I look at these numbers, I say, wow, this is amazing. How fast can you build the wealth? So let's spend about 2-3 minutes on this slide. So for example, Nordin and Nazleen, our two couple, they are 35 years old, graduated, start working, they're working jobs. They both have, for simplicity's sake, 100,000 income. They both make 100,000. So the total income is 200,000. Now they both have 401k. And let's assume, to keep things simple, they both defer $10,000 into their 401k. The limit is higher, as we talked about, right? So let's assume they do 10,000 each. And their company, the most common match is 6%, 50 cents for up to 6%. So that means that if Nordin funds at least $6,000, their employer is going to give them 50 cents for every dollar that Nordin puts, which is $3,000 up to $3,000, for the salary of 100,000. You get 6% of that amount, 50 cents. So that's 3,000. And then Nordin has deferred about 100,000. And then Nazleen has also done, 10,000. So let's come back and look at the numbers. What just happened? If they both did not participate in the 401k, they were in 22% bracket, hitting the ceiling of 22% bracket. So they would have filed the tax return, paid the taxes on. Let's talk about the 20,000 which they have deferred. On the 20,000, they just saved $4,400 in tax deferral because they put money into 401k. What Uncle Sam says, if you contribute, we won't tax you on that money. At 22% on $20,000, that's $4,400 they get to keep and not pay to IRS. And most of the states, if they are not in Texas, you say average about 3% on state STAT tax, state tax, that's another 3%. So that's about $5,000 in total they could avoid by just funding $10,000 each into their 401k. That's the first thing happens, right? So let's compare the two. If they contribute, they get to pay $5,000 less in tax. If they don't contribute, they have to pay $5,000 more in taxes. In other words, either they get $20,000 in their 401k, or they pay the tax and keep $15,000 in their hand right away, right? So now you're talking almost $15,000 and $20,000. That's 2/3. I mean, 66, 15, and 20,000, right? That's first thing happens. Now, that's just the tax. Then their employer is saying, if you do that, since both of them did, we're going to give you 3% matching of your salary, which is $3,000 each. So not only that they saved $5,000 in taxes, So instead of getting 15,000 after tax in their hand, they have the full 20,000 in their 401k, plus they got 6,000 employer match at 50 cents for up to 6% into their 401k. So now we have 15,000 versus 26,000. Just do the math. That's about 70% plus difference between the two. There's no way that anybody can tell me that if I don't do this, I can take this money and I can invest or do something with it. I can catch up with that amount down the line. Well, understandable, you'll say, okay, fine, but don't I have to pay taxes? Yes, we'll come to that later. But today, if you have that option, in this example, just doing 10,000, which is 10%, which is the least I would say everybody should be saving. So by putting that 20,000, you just did that, right? So now it's somebody who is higher bracket. If you're a neurosurgeon working for a hospital and your spouse is also, high earner, you could be pretty much in a 37% bracket with the state tax in California running about 13%. You're talking almost 50 cents goes to your taxes. Now, there's absolutely no reason for you not to take it. If you have 50 years plus, then you can do 26,000 each, and it can save you almost 50 cents to $1, which you put into your 401k. So I just want you to understand this is the most powerful thing that you can do to build your wealth. And, because if you have this dollar coming, you have to take it. No question asked. And we're going to give you some more examples down the line as to how to make sure that you understand this concept. Immediate tax savings comes right away. That's the first thing happens. You get a free matching from your company. You get tax deferred. Now, again, you have this $26,000, which you have been able to defer both of them. Think of it that for next 40 years, they're 35 years age and they can defer till RMD starts, and hopefully that RMD, which get pushed to 75 in the future, 40 years of not paying tax on their income they have in a 401k is tax deferred. It's not tax-free, but tax deferred, right? So huge, very, very, very powerful way to start your wealth accumulation process, especially young people in the 20s. If you have a matching, most of the time they give you this matching. Please make sure you don't miss that opportunity. Do whatever you have to do. 10% minimum savings, you get the free matching, let the money roll and grow into your tax deferred account, and you will see the magic happening in 10, 15, 20 years at how fast that money keeps multiplying out since after that. Okay, so the cons are only that you have to make sure you're disciplined, don't cash it out before you turn 60, because that's where you get hit with not only the tax comes back, but you pay 10% penalty, right? So 401k, the other one is usually the 401k, you have to go with the choices your employer gives, but nowadays that is changing a lot. You get more choices than what you should be getting. People get confused on the other side. So that problem is going away slowly. So I hope you got that point. The other one is IRA, individual retirement account, for people who do not have a choice, who do not have an employer who is participating, or maybe they're not there yet. They're going through school and finishing their college, and okay, I'm finishing my college, but I have income, I'm working, and I'm going to college. I make 50, 70, 80,000, 100,000 married couple. You can still do either traditional IRA or Roth IRA, right? So here's are the limits for people who have traditional IRA. It's the same thing. It's just that lower number. You can defer some money into your IRA account, or you can do a Roth. Now let's spend a little bit of time on this one, because this is another very, very powerful magical thing which I've seen people miss out on. This is extremely powerful tool that let's talk about. I will spend 2-3 minutes on this one. This is for everybody, almost everybody. I mean, the income limit is very, very, very high. For it would qualify most of the people, 70, 80%, you must be in the top 10% of the income group for not to qualify. But this is very powerful. Here's how it goes. So if a couple, let's take another example, Rosmin and whatever, somebody else, a couple, Ramzan, they make $100,000, $106,000 in 2021. This year they expected to make $106,000. Now, they have no 401k. They have just started working. They're 25 years old, and both combined make $106,000. What should they do? Well, I would suggest them to go for Roth IRA. Why would you take a Roth IRA? Well, first thing, you will not be able to take a tax deduction. So now they make $106,000. They put $12,000 into their Roth IRA, but they have to pay tax on $106,000 when they file their tax return. There's no deduction. Well, but just like we have a 401k free money, here it is tax-free for life. This is very, very powerful also, because in Roth, what you're doing is you're paying your toll of the tax upfront. When they file their joint return in 2021, they will pay the tax on the whole $106,000 and not deduct the $12,000. In other words, they're saying, Uncle Sam, go ahead and tax me on this amount. I'm 25 years old, and I'll pay the tax on this $12,000. But that's the big word, that's the free, that I will never, ever pay tax on that money when I pull it out. And if they are smart, if they are prudent and they can think long-term, 25 years to 75 years, that's about 50 years of tax deferred, compounding, and tax-free withdrawal at the end. And they don't even have to take their money out, and when they turn 75, they can let it grow even after that in their 80s and 90s, and they choose when to take it out. There's no required minimum distribution. We'll talk about that in a minute, that there's no requirement in our Roth IRA to even take money out. So here's what it does. For people who have income less than $106,000 in 2021, in the current year we are talking, in my opinion, you should be going for Roth, because your bracket at this point is only maximum that you pay is 12%. And of course, you will pay the state tax, those people who have state tax, but that's only 15% maximum tax you can pay and make your money tax-free for life. Now, that is very, very powerful. If you can, we'll talk about investing and all that later, but that is the key. Who can qualify? People who make less than $198,000 in 2021, they fully qualify. Now, if you make over 198 as a married couple, you start losing out. It's called phase out, and after 208, you lose. You don't have to. You cannot contribute anything. And same rules apply 6,000 and 7,000 for the limitation as to who can put how much. So we just talked about two very powerful tools. First one is that 401k free matching. If you have a 401k where the employer is giving with the average right now, 69% of the employer giving you 401k with 4.3% matching, absolutely don't miss out on that. Everybody should be saving 10%, right? That's a must minimum. Everybody should be saving at least 10%. Now, if somebody who makes $200,000, in the other case we saw, they should be at 15 or 20%, not 10%, because as your income goes up, the percentage should go up, not stay the same, not 10%. Doesn't apply if somebody makes 500,000. In my opinion, there's no reason for them not to be able to push about 40, 50% or somewhere that range, right? Or anything over $500,000, because that's how you grow your wealth. Because if you were to go back, let me go back to that example we talked about, that in this formula, if nothing else happened, the first thing has to happen, what we do in this great nation, that we all are worried about income. Oh, he makes this and I make this and 400,000 and 700,000, because most of our energies is going over here. The moment you push this thing up, somehow this automatically follows your income. Your expenses will catch up. I've been here 30 plus years and I've seen that. It's just no matter what you do, your income, you bump, your expense goes up, and of course the taxes goes up too. Nobody's talking about savings. Income is not wealth. Net saving is the beginning of wealth. And where do we focus our energy on? Always we're looking at, okay, how we bump our income. Income is not wealth. It is the savings that's the beginning of the wealth. Because if you don't save, the wealth accumulation will not start. And that is very, very important. And once you have that process, you can use all these tools that we are talking today, put it on automation. We can do it on systematically. And we'll talk a little bit more about the investment part of it also, how you can make that grow over the years with so little amount of time that you have to spend to work on that. You'll be amazed how fast that money grows. Okay, so let's talk about a couple of retirement plans, SEP IRA, SOLOs, defined benefit plans. SEP IRA is basically simplified employee pension plan. This only works for people who have 1099s, consultants, no employees most of the time. These are most of the time sole earners, very high sole earners. I've got a few consultants, which fits them occasionally, but better choice would be solo 401k. But the good part of SEP IRA is for people who have not done any planning, were just letting go and didn't think of anything. And now that we are in 2021 and they have huge income for 2020, well, you can still come and do the SEP IRA, because that's one of the only business plans that will let you fund for previous year all the way till the extension of this year filing date. So somebody, consultant, just didn't do anything, all of a sudden finds out, hey, I've got 250,000 net income coming. Can I do anything? Well, you can still do SEP IRA. If you file extension, you can go push it all the way before October 15 deadline, and you can open SEP IRA and do pretty decent amount of money into your SEP IRA and lower your taxes. Now, SEP IRA comes from the employer, because this is a pension plan. It's a pension plan. The employer funds it. The employer takes the deduction. If you're a Schedule C person, sole proprietor, you can deduct that amount, that whatever the amount you fund is deducted as an employer. So it's very important to understand that if you have employees and you are one with 4 employees, if you do SEP for yourself, you have to keep the same formula for everybody. You cannot say, okay, I'll get 20%, I'll give them 2% each. It doesn't work that way. You have to give the same percentage to all the employees in that year, right? So that's the only problem, which if you have employees, this doesn't work for most people because it's not cost effective. The cost becomes very, very expensive for most employer who are small business. The next one, better choice for people who have only spouses, husband, wife working only. Same example, consultant, doctors who are getting 1099s or who are getting income from the business, from hospitals, or many other businesses who have some decent income. They can either incorporate themselves as corporation, LLC as corporations, and let them pay the corporation, or you could stay Schedule C, which is as a CPA, doesn't make sense why somebody would stay long as Schedule C because of the liability. It's always better to operate as a business under a corporation, because that gives you limited liability in most of the state and very good protection for a very small fees that you can generate that liability for yourself. So if you have a corporation, either way, you can have a solo 401k. And again, you could defer quite a bit of amount of money, just like we talked about 401k before. Same limit applies here. Under 50, you can do 19.5, plus your employer can give you matching. So somebody who makes, say, example, $100,000 W-2 in your own company, you're a doctor, and you get money from your hospital, or if you're a consultant, you get billing from your company for doing consulting work. You can pay yourself a salary of $100,000. You can defer $19,500 as an employee if you're under 50, and your company can match you up to 25% if you're a S corporation, 25,000 as employer match. So all that become deductible. So this is a very powerful tool for small businesses who are generating good income. And if you have income below 198, which we just saw before, you could also come and do Roth IRA. And we're going to talk about these combination planning a lot more, because a lot of people miss out on those opportunities that you have 401k. And you can also do Roth IRAs. That's the key, which most people don't get it, because it's not either or. You can do both if you qualify for that income. And the last and final one is this defined benefit pension plan. There's a cash plan. These are pension plans which the employer has to set. This is for long term. If your business is steady with high income, you can set up these pension plans and pay up to $230,000 maximum contribution in 2021. The amount is huge. And this is deductible by the employer for the employee, so they can fund you, which is a pension created by the employer for you. So again, it has to be same for everybody. You cannot break it up and say, okay, I as a boss get, there's some discrimination formula that can be applied. It's a very complex. You have to get actuaries in place. But just to giving you a flavor that there are plans in place, you keep in mind, once you become successful, once you have more income, these accounts are very, very powerful. These are ERISA plans where they can give you protection from the creditors if things go bad. Not only that, but it helps you grow money away from your main business on the side, and help you grow your wealth while you are growing your business, and you're automatically putting some money aside in good days when you have good harvest. Take some of the harvest and push it into these retirement accounts for long term, because that's how you save and grow. And last and final one, these are for all small businesses. A lot more small retail businesses that our Jamaat is involved into could qualify into this one. The limits are lower, but these are simpler to maintain and set up. The deadline on these ones are, just keep in mind, is October 1st. 401ks are till December 31st. If you have less than 100 employees, which we know, knowing from our Jamaat, most small businesses do have, you could have yourself and your spouse both be paid by the simple plan and defer 13,500, or if you're over 50, 16,500. You can choose to give 3% matching to that. Again, has to be same for everybody. You cannot pick and choose that I get more and my employees get less. It has to be same. But this is among the other plans, simpler, low cost, and you can have a good amount of money that you can defer into. So you could have this amount of money deferred. And if your income is less than 200,000, again, going back to the Roth IRA, you can do this and you can do Roth. So you can do this and you can do Roth, excuse me. So this is also very, very powerful. Understand these concepts, how they fit in, that you can do A and B at the same time. One is tax deferred and one is tax free for life. Combination of two is always the better of, because as a planner now, I'm getting few clients who are in the 70s and 80s and they're retired and they're looking for income in this environment where you have 1-2% of income from the most of the fixed side. But the more you have buckets, we just give you 2 buckets as pre-tax and Roth IRA, which is after tax, and then you could have some real estate and this and create different buckets. The more you have, the more it is easier to plan at the end, where you can get away from not paying much tax, because that is not only the goal to build your wealth, but also to decumulate when you are on the distribution side. Take it out in a way that you don't pay much taxes or plan to pay less taxes. And that's absolutely okay. We're not talking cheating on taxes. We are talking planning on taxes, which Supreme Court many years back have said it's okay to plan. There's nothing wrong. IRS sued all these planners and said this is wrong. These guys are planning. Supreme Court said, nope, it's okay to plan. And if you do it right, the important part is that we plan to pay the right taxes. So this, I'm just giving you a point that these are very, very powerful, that you have multiple buckets created at the same time, that once you go on the other side of the retirement, you can take some money out from different places and make some. So the final part on this is something new just happened 13 months ago, Secure Act, that some changes were made. So, they have given some credit, so more reason now for employers to set up these plans. You will see, many small businesses who are not offering probably will offer. There's some more credit for auto enrollment, minimum distribution, required minimum distribution has been bumped up. It used to be 70.5. Uncle Sam said, okay, fine, we'll let you take all this money, but when you turn 72, we want to make sure you start taking money out, because that's where we can tax you. Well, that used to be 70.5, but now that got pushed to 72. And probably in the years to come, it will get pushed up even more. Stretch provision, this is something that took it away. Before, you could take your money, if you passed away, you could take the money of the spouse who passes away to the next one, and you can stretch it to the life or give it to your beneficiary. But now they say, okay, you have to take the money out from the IRA of a person who passes away in 10 years. So say I pass away in 30 years and leave $1 million to my kids, they have to take money out, the $1 million, in 10 years. That is change. Before they could, the kids could take it out in their lifetime as they wanted, but now they have cut the amount so they can collect more taxes. So that has changed. That is kind of negative, but the positive are that if somebody who is working in the 70s, now they can still contribute to their 401k, which is very different. That before they would say, okay, at 70 and a half, you will have to start RMD, you can start taking your required minimum distribution, but you cannot contribute anymore. Well, now you can. So our new president, Biden, he's 78 years old. He makes $400,000 from the government. He can contribute to his 401k, and he's already started his RMD, so he's doing that at the same time. But the new thing has happened now that he's getting a W-2, he can start contributing back again at the same time. So this is what the rule is. And then there's also a credit that you can get. You can pull money some out from your 401k for $5,000 and $10,000 maximum for each partner, each person, joint person, for this benefit for the child adoption. Okay, so we're going to take a little break. I'm going to take a water break also, and I'm going to open for some questions. Azra, if you have some questions, we can just take some questions.
Yeah, thank you, Roshan. That was a lot of really good information. So we'll take a few minutes to ask a few questions that have come into the chat before continuing to the second half of the presentation. So the first question we have here is, I make $300,000 a year. What are my options if my annual gross income is over the contribution limit for a Roth IRA or an IRA?
Oh, good question. Very good question. So, okay, if you make $300,000 and you do not have any 401k, surprisingly, but if you don't have it, you do not have an income limit for that IRA, which we just showed you, that $125,000. That is only for people who have a 401k. And if you do contribute into your 401k, then you have to make less than $125,000 for you to contribute into your IRA also, right? So only for those people. So, but if you say, I do not have, in this case, the question is $300,000, no 401k, never participated in 401k in the current year. Can I come and do at least a IRA? Yes, you can. There's no limit for you for that. So you can still do the IRA, at least $6,000 or $7,000 if you're married. Now, if that person is the only bread earner and the spouse is not working and he's the only one who or she only makes $300,000 by that person itself, you can still do for both. So you can do 6 and 6 or 7 and 7, depending on the age, at least. So that's a good start, at least $14,000, better than nothing. Good question. Very good question.
Great. Thanks so much. So the next question we have is, if I get a 1099 because I'm self-employed, what are the ways I can contribute?
Okay, 1099. The best thing would be, I would suggest, look into setting up a solo 401k, because if you're self-employed with no employees, then solo 401k is the best way, is the cheapest way to go. More and more companies are letting you offer that for a very, very minimal price. And as I said, you could defer pretty significant amount of money, the full amount, $19,500 or $26,000, depending on your age. And you can set up yourself a matching, because you're the only one there, 25% matching from employer, which is 100% expense for the business. So a solo 401k would definitely be a very powerful tool if you can do that.
Great. The next question we have is, I am married. Do I have a separate retirement savings account for my wife who does not work? If she is a homemaker, does she qualify for a retirement savings account?
Absolutely. Wonderful question. Yes. So when we talk about these IRAs, so the limits that we're talking, which Uncle Sam IRS gives you, that's for a married couple. So when you file as a married joint tax return, those 198,000 or whatever those numbers are, is based on the joint filing joint return. Well, but if only one spouse is working and one is not working, these are IRA accounts. It's called individual retirement account. So you could still base, even although one person is working, you can open an IRA for both. And I'm going to give you an extreme example. that somebody who makes only $20,000 or say just make $14,000 and they both are over 50. So Uncle Sam even allows you to put 100% of your earned income into your individual retirement account. So you could take entire money and push into your IRA account. Although only one person makes that 14,000, you can do that. So it's very flexible from that perspective. So you will have to open two separate accounts because it's individual retirement account with their own social security numbers. Very good questions. Excellent.
Awesome. The next question we have is, could you please quickly highlight the difference between SEP IRA versus simple IRA for business owners?
Yes, so SEP IRA is basically a pension plan. It's a simplified employee pension plan. So the funding comes as a employer side. So your employer is giving you money to the participant. In this case, you can deduct, if you make $100,000, you do $20,000 employer match as a pension. So you can deduct $20,000 on your tax return on when you file the tax, the Schedule C or LLC, whatever you do. So you can deduct that as employer. This is an employer pension, employee pension. In a simple plan, basically you set up a plan which you have to file just like a 401k, but a mini 401k, you could say, where you could have, if you're over 50, 16,500 be deferred on your W-2. Now you have to have on income, you have to have a W-2 in your S corporation or whatever that you are operating as, and you have to take salary and then you defer that your salary and then you defer just like a 401k and you get 3% matching in this case because the limits are very low. That's the only drawback. You cannot match 20 to 25%, but no, it doesn't matter, but still you can get 16,500 for each. You and your spouse, if you both work in the business, you can do both. So that's the big difference.
Thank you. We have two more questions.
Sure.
So if I started a Roth IRA and have funded for the past 2 years and my income has increased above the limit in the third year, can I contribute to the Roth IRA in the third year?
No, the limit is per year. So very good question again. So if you have a IRA for each year, you have to go back and look at, did you cross that income limit? If you are under that limit, absolutely, then you can take the full amount. But between that 198 and 208 for 2021, you start phasing out so that every $1,000 you go into that phase out period, you do $700 from your amount that you can contribute. So at 207, you probably can only do 700, right? So give you a point. So no, just because you started doesn't mean that you can continue. And also on the other side, people ask, hey, if I start once, do I have to keep funding every year? No, you don't have to. It's your choice. But you have to qualify for each year. So I'm going to give you a little bit more tax planning idea for you, for who's talking about Roth IRA, that if you do have a opportunity for 401k, if you or your spouse both take, say for example, your income is $210,000 for 2021, you don't qualify for Roth. Well, but if you can go and take $20,000 into your 401k, 10 for you, 10 for your spouse, both take 10,000 each, or you take 19,500, whichever. Now your tax, we are talking modified adjusted gross income, that 210,000 minus this 19,000 or 20,000 brings your taxable income to 190. Now you say, okay, 190, 198, you do qualify. So this is also very, very powerful, that if you're that close to that limit of maxing out or getting disqualified, maybe you want to push more money into 401k, you take that 401k, lower your taxable income, and you become qualified for a Roth IRA also. I hope that answers the question.
That does. Thank you.
Any more questions?
We will continue on with the presentation for now. So if anybody has any questions, please continue to put your questions in the chat. We'll continue with the presentation, and time permitting, if we have some time at the end, we can answer some more.
Yeah, so very good. Now that we have done, just think about what we have talked so far. I'm going to recap again. I'm so glad people are paying attention and asking those question that tells me that yeah, people are listening. Very good. So what we have just talked about, that we can defer money, all we are talking about is tax benefit, right? In the first example, we talked about 10,000 each. We deferred money. We had $15,000 after tax money, or you could take $26,000 before with the matching and all that. So if you do that for, say, this couple who is 35 for 40 years, now that person at 26,000 times 40, you're talking $1,040,000 in their retirement account with zero investments, zero risk. They have not done anything. All they have done is open the right account, taking the benefit of the taxes, getting the free money from the employer with 3% matching for the salary, and assuming that the income never grew up for 40 years. So you have $1,040,000, just do them at $26,000, 26,000 times 40. And on the other side, this person who was paying tax and didn't take 401k in their hand, they'll have 600,000, 15,000 times 40. So just by creating the right account, getting the free matching from the employer, taking the benefit of the pre-tax money which Uncle Sam gives you as a tax deferred basis, you have just created a difference of almost $440,000 between the two accounts, right? 600,000, 1,040,000. Now, that is the first step that we want to bring to you. You understand this concept, never miss that matching. And let's move on to the next one, which is even more fun, where what you have put aside will be so much better if we can do some and make some money out of it, because that's the second important thing that you have to do. So let's jump into the second part of it, is called investing. Before we go into investing, let me ask you a question, or let me give you the answer. There are 2 rules that you have to learn about investing before you start investing. If you have already done it, good. But now if you didn't know it, I'm going to give you those rules. There are 2 rules of investing. If it was a class, if it was in person, we would have asked you. But I'm going to give you that answer. There are 2 rules. Rule number 1 of investing: don't lose money. Rule number 2 of investing: don't forget rule number 1. Right? This is not my thing. This is Warren Buffett, our young investor who's turned 90. That's his philosophy for years and years to come, that if you can learn these 2 rules and always remember it, you'll do very good when it comes to investing. And here are some of the classes that we talk about. Let's start with very basic. On the bottom right-hand side is the risk, and on the left is the return. So there's cash, which is CD, savings account, checking account. These are all cash. It's very safe. The problem is that it doesn't give you much return. And nowadays, if you're very lucky, you can get a 3% CD or 2% CD is probably normal now. And 10-year treasury is about 1.4%, 1.1%. Then CDs probably won't give you much. Now, bonds are many different types. You could have a corporate bond, which are AAA, BBB, and CCC, or even junk bonds, which probably would be categorized all the way between from here to here. There are like multiple layers. You could have different type of layers depending on your asset balance. Could be AAA, and then you could have some junk bond also. Then you go to international bond. There are countries which are paying you a whole lot more than US does, but the problem is the currency risk, and also the risk of principal. The countries which are paying you a whole lot more, the interest rate is much higher, 6% and 5% and all that. But then you hear of defaults all the time. So you need to understand that once you start going international, you're talking much more riskier because of the currency and other issues. Well, real estate. Most people will say, oh, real estate, why is it so high in the chart? Because, why is it so much riskier in this chart? Well, because these are usually, when you're talking real estate, these are REITs, where managers will come and take money from the public and invest into, malls and single family units and, office buildings, and all kind of different REITs are there now. The only issue with these are they almost always leveraged, so sometimes they're 5 times leverage, sometimes even more. So that's why they are riskier, and they pretty much move with the market now over the years. Stocks, of course, we all know. We'll talk about that a little bit more. There are different types of stocks, and there are about 8,000 stocks publicly listed in the US right now, and many, many more. The S&P 500 is the 500 largest company. Right now, as of December 31st, S&P 500 made about 81% of the market cap, which is the market cap of the U.S. market as of December 31st was about 41 trillion, and 81% was 500 large companies. So in the world market as of December 31st was 104 trillion. So 104 trillion, 39 trillion is us. We are about 41 trillion. So we are about 39% of the world stock market in the US. It used to be a whole lot more, but now over the years, other markets have picked up. So we have gone down in percentage wise. Then comes international. As I said, there's only 61% of the world market is now outside the US. So this is also to be looked into. And look where our small businesses, where we all come in. I'm a small business myself. Most of the people who are logged in are small businesses, no matter what type of business you are. We are placed right on top of everything because we are the most riskiest. If you're investing into your small business, which I hear is from our community all the time that, hey, I invest into my business. I don't need to talk about this 5%, 7% and diversification and all that. Well, you are the most riskiest of all because everything is tied to you, your business. If you fail, if your business fails, your income goes away, your asset goes away, all at the same time. That's why it is very, very risky to have your only business, especially. You could argue, hey, I've got 5 gas stations, or I've got 5 gas or sandwich stores, or I've got 5 of dollar stores, or 5 of salons, or whatever that is, right? So, well, but they're all in the same business, same type of business. And see what just happened. Who would have thought that what we saw in last 12 months or so, that all of a sudden so many industries will be put to test. All in a matter of 5 weeks, everything changed upside down, right? So that's why personally I say, if you have a good time, if you have a good harvest every year, even if you making recent money, try to take some money and push it into all these assets in your 401k. Although, these assets will not give you anywhere close to your business, and that's why you see most high risk. And we agree, we accept that you can make more income, more percentage-wise income in your business, but it is always high risk, so you can take that money while you are making into different accounts. And these are simple way to invest that when you have a short term, you want to make sure that the problem is if you go too conservative, then you won't make much return on the money because the inflation historically have been 4%, now it's 2%. You have to beat inflation. If you go too aggressive, then of course you're breaking the rule number 1 of investing, that you may lose your principal, which we don't want. So there has to be a balance how you invest and how you can generate money and not lose money and at the same time beat inflation. That's why we're bringing this, so you can learn, understand that it is doable. People have done it. Market gives you opportunity. If you know that you don't have to swing your bat on everything and try to hit to the fence every time that you invest. If you do it slow and steady over long run, it could be that you could make good money over the long run without taking much risk. And that's the key part that we want to bring in our presentation today. We all talked about the emergency funds. This is not the money that you invest. It is conservative for quick liquidation. Retirement money, be more moderate aggressive because this is again your retirement. You don't want to be buying options and you don't want to be buying GameStops in this thing or even margin trading would not be appropriate into retirement account. None of these applies. In my opinion, all of these should be away from retirement account. Retirement accounts are for your retirement. That's the last thing you want to risk is your retirement account. Yes, if somebody has that itch of doing something and playing the GameStop or Bitcoin or whatever that you are interested, but would be only on a side account on a very small basis, not on your retirement account, not your family future. So that's very, very important that you understand. These are good tax benefits, but not the right investment in these accounts. Very important that once you start, if you have never done it, understand your risk, Risk tolerance is very important. The longer time you give us, the better it gets, because that's the mindset should be. As we are talking about somebody in 20s or 30s or 40s, we're talking 30, 40 years long planning that we are doing. And this is the power of compounding. It says power of saving, but it's power of compounding. Basically, you can take a small amount of money, invest it for a long period of time, look at what the magic number it does. In 10 years, the same amount of money, $1,000 every year for 40 years, which you invested only $40,000, can grow into $500,000 with, of course, 10% rate of return, right? So you may say, whoa, where do you get that, right? So we'll talk about a little bit more on the market, but look at the number, what it can do. The time, the power of compounding, that's what we're talking about. And once you study the markets a little bit, you'll know how markets have done over the years, because that's the key of this whole message is not only that you take benefit of taxes, not only you take benefit of free matching from your employer, but take benefit of the markets, market in general. We're talking broad investments, you spread out over many, many, many different classes. There are 18 different classes in the markets. When you talk about try to invest into everything, we're not talking about picking one stock, forget that at all in retirement account, but we're talking not only picking one. If you are an IT guy, you say, I want to put all my money into IT stocks. That's not even, you're trying to say, go even broader than that, because you're talking 30, 40 years long and very broad. So here's what it does for different rate of returns. This is called rule of 72. You take 72 as a magic number, which you divide that number by whatever percentage you're getting or you're expecting to get, you'll get how much it takes for it to double. So take 72 and you take 6. If you get 6% consistently over the years, you divide 72 by 6, you'll get 12. So your money will double every 12 years. It's called rule of 72. If you take 72 divided by 10%, which is consistent rate of return, your money will double every 7 years. For 7% divided by 72, it takes 10 years to double your money, right? So, well, you'll say, why would I do anything else? I want just 10%. Don't we all want 10%? I mean, if you're anything like my client, I want the highest return with the lowest risk, with no fees, and I have very little time to invest my money, right? We all want that, but I have been trying for the last 20 plus years. I haven't found that yet. As soon as I find out, I'll be the first one to come and tell you, but it doesn't work that way. You have to give some to get some. You can't get, cannot get both. So, so here's very simple. What is a stock? Is an ownership in the company. I think when you look at some of the things happening in the current market, it's amazing how 10 million new brokerage accounts were open in 2020. 10 million. 6 million were open in the last 5 weeks in just this calendar year. It's become easier to open a brokerage account than to make an omelet, especially for me. I can tell you that amazing how many people have opened and trading those accounts, because that's not the way, definitely, I would say, the way to go for your retirement account. Yeah, there might be a place for that. There is definitely a place for everything, somebody may argue, but not in your retirement account. So this is something you want to make sure that you understand, that this is, if it's all the thing that you do, all the hard work you do to make money, you're sacrificing so many things to put money aside, you don't want to lose, because if you have a broad portfolio, chances of that going to zero will be almost nil. Versus if you pick a stock, or especially if you do margin, or if you do options or whatever, chances are 90% failure rate on some of these investments. So why would you even try something like that, right? So the whole idea is understand these tools that we have, stocks, bonds. By the way, we just said bond market is $41 trillion, right? $41 trillion. Well, bond market is even bigger. Bond market is even bigger than stock market. When we think of financial institutions, we always think of financial markets as stocks. No, bond markets is even bigger than stock market. And, there's so much more to learn about these. People just ignore this sector. In my personal practice, without knowing anything, I would say everybody at least should be having 25% bond in their portfolio, especially in your 401k plans or IRA plans, because that gives you a cushion. Even if you choose the other 75% to go to S&P 500, maybe 25% international, maybe another 25% to some other REITs or whatever, diversify, but different classes, right? That's the key. As much as broad as you can go. Another one very important part is a significant amount of money in Wall Street right now has been invested through mutual funds. So there are so many different mutual funds. There are some good managers which invest you. You have to learn. You need to understand. The two important things, the cost, because every mutual fund is managed by somebody. You're paying them, and they have a criteria as to where they're going to put your money into. And there's a stock mutual fund. There's a bond mutual fund. Even in stock, they'll say, okay, we invest international, small cap, large cap. It will define it, tell you exactly. They have the limitation as to where they can invest your money. And you get to know how much they cost, how much they charge you. Not 100%, but at least you get to know most of it, that what is the cost. And that sometimes becomes a challenge when you're thinking 30, 40 years of investing. 2% mutual fund expense becomes a challenge over 30, 40 years. So you have to also watch out for that you're not paying too much into those mutual fund expenses. That's one important thing when you look into mutual funds. ETFs are becoming very popular. These are you can pick a index like there's an index for S&P 500. There's an ETF of S&P 500. The good part is it trades, it prices during the market. You could buy and sell during the market hours, which is some people want to be more finding out, okay, you can buy and sell. An index, on the other hand, the 500 index for S&P 500 will only come with the pricing at the end of the day at 5 o'clock, Central or 6 Eastern, that you will get to know what the price was for that day. ETFs, you can buy and sell, so you can figure out, hey, it's up or down. ETFs are becoming very popular over the years. The advantage of that is low cost. I personally, in my practice, people who want to go systematic, dollar cost averaging, that's what I do. I prefer indexes, and not only just US index. When you do US index, you're talking 8,000 equities. You do international, you have 11,000 equities in there. Then you do bond index, and you mix it with some REITs. You got a portfolio which probably may not be the winner every year. It probably will never be a winner any year, but at least gives you safety, security that your money will be there. You may not make 94% or 74% like GameStop in a week, but at least you know your principal is protected, right? That's the key. You need to repeat yourself. The day we can learn how we can protect our losers or protect our money going away 100%, that's the day you could see definitely that your rate of return will automatically get better, because that is the key of investing that I have learned over the years, that is, we all have to learn and make sure that we don't lose money. The advantage of mutual fund is, of course, I talked to you briefly about that. It's great that they do all the work for you, manage it. The only negative sometimes becomes that those are narrow. Those are about 100 stocks. They pick 200, sometimes even 40, 50 of them in a mutual fund. So you have to also look out for that. And the fees, there's more churning going on that cost money too. So end of the day, cost is an issue, rate of return. And also very important, when you look at a fund in your 401k or wherever, you may be saying, oh, I like this one because it has 11% return for the last 10 years. But keep in mind, that's historical number, right? Even Morningstar or whatever that you have, they can only give you what happened last 10 years. It's possible that 2 years ago, the fund manager who was managing for 17 years just left it. And now you have a new manager, which you're not seeing that negative or bad performance or not that good of a performance in the last 2 years. And the fund manager has gone and you say, oh, that 11%, I love that. So just keep all these things in mind. We just want to give you, so it's, always you can learn more, get better. There's no perfection anybody can do. I'm still a student myself, so I'm just sharing that I have learned. But look at some of the returns that we have seen historically, and these are not 1-2 years. These are pretty long timeline that we are looking at. It's more than 80 years or so, historically performing the markets. And If you go from 13 to 2020, not much has changed. In fact, that line would be even better in the last 7 years. And what the message is, you got to have all of it in your portfolio. You don't say, okay, I like this one. I want this one only. Let's put 100% of the money is 11.7, almost 12%. No, you put, although you have money market and bonds are only giving you a very small amount, you want to distribute into every different field, right? Because that's how you get the cushion. And let's talk about this timeline. The longer you give yourself, the longer you think of putting money and not touching it, chances of you making money or coming out positive is much, much higher, right? So look at this. This is S&P 500 in one given year. I think this was 2008 number. We started the year and we dropped 43% in one calendar year. S&P 500 did 43%. You started with $1 million, you are left with 570,000. During the 3 years, 2007, 8, and 9, S&P was down 55%. So these are the top 500 companies in the US. So even on a shorter period of 3 years, we were down in that timeline. Nothing worked at that time. I remember very well that it can happen. So we just want you to understand that this is not the time where you would say, and you panic. Because the best deal as an investor, you get it where people panic and they're selling out. That's the best time to invest. Very hard to do that, but you don't want to be the seller when something like this happens, right? That's why the reason I said buy something which is paying you 2-3%, bonds 25% into your portfolio, so that you can stay in the market. We just saw this year, right? Not too long ago, 12 months ago. February, everything was fine in 5 weeks. In 23 trading days, market dropped 35%. S&P 500 did, right? 23 trading days. Unbelievable what happened. If you, by the time people woke up, the market started going back, so it didn't last long. But if we would have stayed there for 6 months, or I would have bet a lot of people would have started cashing out. Luckily, not too many did, and I hope you didn't, and nobody did. But it can really make you stay up at night. So that's why even if you diversify, so you don't cash out at the wrong time. Look at real estate, right? Even real estate can go down. We all learned in 2006, 7, 8, and 9. It was down almost half in some of the best markets in the country. So this is inherent risk that you get in the market, that this is there. You just have to deal with it, live with it, plan for it, that it is going to happen. Will there be another 30% drop? Absolutely. When? I don't know. And that's why we all know that we have to plan for this is going to happen just like this time. Some point in time it's going to happen. So you just plan it out in your portfolio. Very important that asset allocation. Asset allocation is that when one thing goes up, one thing goes down, that's allocation, right? So because everything cannot be going in the one direction. If you have everything in your portfolio which is just going one, chances are when thing goes bad, everything's going to be down one way too. And that will be very hard to take when it drops so quickly. That's why we say take some money, diversify. Diversification is going across. Allocation is that you go up and down. There's something going up, something is going down, which is very important. Look at all the pension funds, university endowments, charitable organizations, which have billions of dollars. They all do this asset allocation. I read about Yale University. They have timberland in their portfolio, which is officially they can plant trees and cut trees. And of course, they have real estate. They have this. They have all kind of different investment, different asset class away from the market also. And also recently I read about Bill Gates, that he's the biggest farmer. He has the most farmland than anybody in the country as a private investor, 240,000 acres of farmland. I don't know if he knows anything about farmland, but that's an asset that you put aside. So these people, smart money, this is how they diversify. We can all learn from these people that you diversify into different classes so we protect our money for long term. And this is one more important concept I'm going to bring out very quickly. It's called modern portfolio theory, which is basically what it tells you. And there's a Nobel Prize given for this simple concept, which I'm putting on a slide, which EPB has put together. Amazing. That if you have a 100% money put into bond, which is kind of a safer one. There are two things that we are looking at. Historically, the returns were 5%. And then the standard risk on that one would be 8.5%. Well, if you take that same and mix it up with different classes, midterm bonds, short-term bonds, large company stocks, small company stocks, and then create a portfolio, your return is still the same, but your risk has come down by half, because your portfolio is not going to move that much now with this with adding few classes. And now with this, you can, with the same thing, if you portfolio-wise, you say, okay, I want more return, you can get the same risk in the portfolio, but much higher return with increasing more stocks and all that. So this is a theory. You can read about it, learn about it, because this is very, very powerful. It's not taking one stock, definitely not as, you like Apple or you like Google or Tesla or whatever. That's not how you build your retirement. In your retirement, it has to be broad. It has to be long-term. It has, it could last you without making a change for many, many years. That's the key, that you keep doing it. Dollar cost average, which we call it, in your 401k, which you fund it every week, every 2 weeks, or whatever the way you get paid. Money goes into it, into different classes. Keep adding it. And that's the way you build your portfolio and your long-term retirement goals that you meet. So these are some of the important points that we just discussed. Stick to your plan. Don't excuse me. Don't panic when things are bad, because once you have a good plan, then you can just continue. That's the key. Especially when the things goes bad, that's not the time to rebalance, because that's unfortunately the bad thing can happen. We say, oh, I forgot, so let me do it now, then I'm 30% down, because now you're selling stocks and buying bonds at 30% down, which should be the other way around. If you had cash, if you had bond, if market drops 35%, you should be buying stock and selling bonds, and other way around. So I'm going to end up with one quick story, as I started with one, there was a one person, what's going on in the market. You look at things that happened last few weeks, and also in my personal experience being in the market, and Wall Street will come and have a way to give it to you in a nice packages, things that are sometimes not intended with good intention. So you have to keep an eye on this. I'm going to give a story. Hopefully that story will remind you when you come across something. There was a small town which was surrounded by forest. So there were a lot of monkeys there. So this person moves in with his assistant and announces to all the villagers that, hey, we are here to buy some monkeys. And if you can catch a monkey and give it to us, we'll pay you $100. And everybody said, wow, $100 for a monkey? I mean, that's so easy. There are so many monkeys. People went around and started catching monkeys left and right. He had a big cage. When they bring a monkey, they'll put it in the cage and give him $100. Everybody was excited. They went and worked hard, got more monkeys, he got more. But eventually the monkeys all were gone. So now when nobody could catch any more, he said, I'll give you $200 for the monkey, for each monkey. Oh, people said, well, let's go work hard. They went out, found some more monkeys, sold him. Eventually, all those monkeys were gone, so nobody was giving him monkeys anymore. When that happened, then he announced, okay, fine, I'll buy your monkeys for $500. And everybody worked hard trying to find monkeys, but there were no monkeys. And then the person said, listen, I have to go to my city. I've got important work to do. When I come back, you catch the monkeys and I'll pay you $500 for each monkey. And these guys were trying to find monkeys, couldn't find it. While he was gone, the assistant goes around in the village and tells everybody, listen, my boss, he's gone to get some money and he's gone there for some work. And he comes by, he's going to buy monkeys for $500. And I've got some monkeys in private, in quiet. I'm going to sell you this monkey for $350. So when he comes, you can take this monkey and sell it for $500. Everybody said, wow, that's a good deal. We can make some more money. So everybody bought monkeys. Some bought one, some bought two. And all the monkeys that they had caught, they bought it back. And in a short period of time, that assistant was gone. They could never find that two people ever. And they never saw them back. So now here they were. They have those monkeys in their hand. And they lost the money, not only the money that they have received earlier, but they paid more from their pocket. And this is typically what happens in the market all the time. We just saw that, we just saw that with GameStop. We saw that with so many things happen, which is called pump and dump concept. So be mindful, watch out for those. Those are very hard to detect. Don't fall for that, because you'll be holding the monkey and also you lose the money. So here are some suggestions that if you're looking for some help, you could go to for this credentials, CFP, CFAs, IRA, RIAs, which are registered investment advisors. There are some websites that you can look into for if you want to hire somebody to help you with investing, and there's EPB has a directory. With all that, I'm going to give it back to Azra to take some more questions.
Great. Thank you, Roshan. That was a lot of really good information. And thank you again for your continuous dedication on educating all of us on retirement savings. I know I definitely learned a lot from today's session, so thank you.
Thank you, Azra.
So we've received numerous questions in the chat function. So for those of you who wish to stay on the line, we're going to spend some time to discuss some of these questions. So the first question that we have is, if I have a IRA or a 401k and I pass away suddenly, what happens to that money?
Very good question. Sorry, I didn't cover that. So very important when you set up any of these retirement accounts, all that we have talked, simple, SEP, 401k, IRA, Roth IRA, whatever, you make sure the day one that you are confirming your beneficiary on it, and periodically go back and make sure you update your beneficiaries, because these accounts override your wills. So even if you had a will which was outdated and old and you have changed something, whatever is on your retirement accounts as a beneficiary, there's a primary beneficiary and there are contingent beneficiaries. So whatever you put as a beneficiary on your retirement accounts, any of these, that is where the money is going to go to. So make sure you set one up from day one and go back and revisit those and make sure those are updated. So good question. Very good question.
I actually just updated mine last week, so good to know.
There you go. Excellent. And it's amazing how people, younger people, they think just like, they say, oh, I don't need a will. Well, sadly, we had stories in last few years that people who are young, they should be mentioning that very importantly, because there's really, usually the spouses are easy to put, but whatever it is, if you're single, if you have a job, you must still find something, even if you have just parents and no siblings, put somebody on that. So at least the money would go, God forbid something happens.
Great. Thank you. So the next question we have is, can you please explain the importance of compounding in investment returns and simple investment returns?
Yes, very good question. So the good part is, all these accounts that we talked about, the benefits of it, IRAs, Roth IRAs, 401k, simple SEP, all of these are called qualified accounts. The qualified accounts are basically, those are deferred. These are retirement accounts. Once you set it up, wherever you set it up, that institution will have to report it to IRS that, yeah, so-and-so has opened an account, they have an account, and it gets reported to IRS. The benefit you get is whatever income you're generating into these accounts, those are tax deferred, which we talked about earlier. So that means that whatever you generate into that account, you can keep in that account and keep adding to it and keep multiplying into that account. That's called compounding, because there's no tax. Everything stays in there. Now, we talked about the earlier example of 401k. If you didn't do 401k, then you have this 15,000 in your hand. Now, let's assume that person goes and invests money into mutual fund, makes 20%. Guess what happens? Every single year, you have to pay tax on the income that you generate in your account. So not only that you have start with much lower base, but now you have to keep paying tax on it. It becomes a taxable account. So one is qualified account, which is simple interest you make, minus the taxes that you paid. So that's even worse. That's why we say these are the best ways to start, best way to accumulate, because if you can take benefit of these qualified accounts, whatever combination you can, take it, because these are the benefits that Uncle Sam gives you every year. The more you take benefit and push money, the more you can grow your wealth.
Great. Awesome. So this next question is actually one that I was thinking about as well, is if I have an old 401k from a previous employer, what is the recommendation for what to do with my old 401ks? Do I roll it over or do I leave it there?
Okay, so you will, usually it's a good idea if you have one 401k and those are good ones. If you are able to keep an eye, able to rebalance, you decide. Most of the time the question comes in, okay, fine, I've got, usually get clients who are baby boomers and they have been like in marketplace for 30 years and they come up with 11. I had one with 17 different places. So first thing we said, listen, I am not going to even try to help you till you decide to move, because it is impossible. If you have placed 11 different accounts, IRAs, Roth IRAs, 401ks, how do you balance? How do you know where your money is invested? So usually it becomes a good idea to start rolling it over, bring it, narrow it down, maybe 2, 3, 4, whatever you're comfortable with. Because diversification is not opening 11 accounts. Diversification is consolidating and then diversifying into different categories, because the key is that you can rebalance easily. You know exactly where the money is invested. How is it doing? You can check it. The cost is an important part. Choices are a very important part. That where you invest your money, because you should have those choices, right? So those are the things. And usually, personally, and many financial advisors would say that try to consolidate so you can keep an eye. So that is not, we're asking you to put all your eggs in one basket. We're asking you to make it to a point where you can be able to see and manage where your money is, how is it doing.
Great. Thank you. The next question we have is, can I get a better return from my business investment, which I will use for my retirement? Why should I save separately for retirement?
Risk management. It's all about risk management, because you have to understand, and we just shared briefly, that no matter what business you are, right? I mean, you think of Blockbusters and you think of Sears and you think of JCPenney's. I mean, these are multi-billion-dollar companies. They're gone. I mean, these were never, anybody would have thought ever that in 30, 40, 50 years ago that these companies will be no more, because there's a disruption going on everywhere. Any business, and we all know that Blockbuster Netflix comes in and Netflix, so things will happen no matter what business you do. If you come to me today and you can say, okay, I've got this $10,000, I'm investing, nobody can say with guarantee that I will be in business 5 years from now. Because, if you look at the numbers, there are 1 million businesses started every year. 80% of them fail within 5 years. In next 5 years, 50% of the remaining 20% which are there fail. So that means in 10 years, 90% of the new businesses will be gone. So that tells me that small businesses like you and me have the risk. So, always take benefit of what you have, diversify. You're sacrificing the higher return, but you're at least protecting some money. So in my opinion, being a CPA and being a financial planner now 20 years, that would be my advice. Take some money while you make money, and put it aside.
Awesome. The next question we have is, can I trade within my retirement account?
No. Trading is not, not the place to be. I mean, if you really have the itch to do it, a very tiny portion, maybe 2%, 3%, whatever. Some people do it no matter what I tell them. I mean, I know my doctors are very, very, very big into it. I've got 40% of my clients as doctors, and I just can't, many of them do. So, but, this is because retirement plans are not simple, because these are something you have to put your mindset that this is not the bucket I'm going to touch. Of course, if you have even, when you build your retirement, there's usually, we say, try to build different buckets. Your 401k bucket, your Roth IRA bucket, your regular brokerage account bucket, because that's how you create different type of risk. If you really want to take high risk, and if you have 5% of your money, which you want to see if you can make 14%. But let me tell you from my experience, there's absolutely no science that we have found that by you increasing the risk, you will get more return. Absolutely no. Market has no respect for that just because you have taken so much risk, you ought to get more return. Most of the time, it's the other way around. You increase the risk, chances are you're going to lose money. It's not about running fast, or you say, I'm going to drive 140 miles an hour. It's just like, okay, I'm going to run with a candle across a dynamo factory, and if you come on the other side alive, that doesn't make it okay at all. That was the riskiest thing that you did, and you should understand that is not appropriate. So for long term, diversify, stay away from option trading, stay away from margin trading. Of course, most of the IRAs will not even allow you. So not in retirement accounts. Again, I would say especially not in retirement accounts.
Great. The next question we have is it a good strategy to invest in real estate for retirement?
Most of these retirement accounts, especially in the IRA account, go physically buy a property. It's restrictive. You cannot, there's a process you have to go through. But part of the investment that you do, as I mentioned, that there are a lot of good REITs, real estate investment trusts that you could buy. These are publicly traded. Yeah, there's a place for real estate in your portfolios, like any other portfolio, maybe 5%, 7%, 10%, whatever your risk tolerance is. Small portion with some bonds, international, US, diversify, right? So yes, it is, but not like buying a shopping complex with all your money, which you have saved over 15 years. That's probably not the best route to go for retirement account again. Because now what you're doing, you took all the money, what you have done, you're buying one single asset. Again, you have just increased the risk by tenfold. Versus if I were to buy my money for $500,000 into the market with S&P 500 and international, I mean, my risk is very broad, diversified compared to this.
Awesome. The next question we have is, if I have passive income, can I contribute to a defined plan?
If I have only passive income, then the answer is no. You have to have earned income enabled for you to qualify for all these retirement accounts. So that's the only catch. So for example, again, let me clarify for people who did not understand the question. So for example, you have just a real estate income coming, you have rental properties, 3 of them. You have, a corporation, S corporation, which you do not take any salary, you are 100%. You make $50,000 from your S corporation, which comes to you as a K1, which is passive. And you have 0 W-2, you have 0 earned income. You don't qualify for any plan because you have to have earned income to participate in IRA, SEP IRA, or whatever you do. You have to have earned income. So passive income is where you do not earn money. You have all the money coming from your trading stocks or dividend from investments. All those are passive. You have to have a W-2 or a earned income. That's the answer. Good question.
Next question we have is, what expense ratio is considered reasonable?
For the investment side, I would say somewhere about 1% or less would be a good number. If you can look around, and because you fund managers have to be paid, they would not. Nothing is free. It's amazing how many times I've heard that sentence that, hey, I have never paid anything for my 401k investments. It's free for me, and I have $600,000 in there. I never pay any money. No, it doesn't work that way. There's always a fees that you pay to the fund managers. It comes out from your investments. And also, if you were to invest money outside those retirement accounts, your person who is doing the work for you, they need to be paid, and they do get paid. So you need to understand that. But 1% is probably a good number if you can get yourself under 1%. For bigger amounts, it's always easier if you have a $10 million asset. I mean, of course, then 1% is too high. But for average person with average assets, 1% would be a good number. That's the standard for the market.
The next question we have is, can you please clarify under what conditions can someone have a 401k as well as an IRA or a Roth IRA?
Excellent. Very good question. This is a hybrid question that we were talking about. So everybody who has an income somewhere about hitting the 200,000 mark, I would say you should be thinking of doing both, because it is very, very important. So if, again, the very first example we talked about, a couple making 200,000, both funded 10,000 each and got them matching. Perfect, very good planning. But that couple, in my opinion, should be going back and taking their Roth IRAs of 6,000 each every year, beside the 10,000 they funded. So that would be the more, I would say, from good to better investment or prudent investors, because you just took 10,000, got the matching, got some deferral of 20,000, and now you created another bucket, which is a tax-free bucket, by putting 7,000 more each into, or 6,000 each into Roth IRA. So if you have a 401k and your income is staying below the 198 mark after you deduct the 401k, you are fully qualified to do the Roth, and it's preferred that you can do both.
Great. And the last question that we have here, Roshan, we have the CARES Act was passed in 2019. The deadline to withdraw was on December 31st, 2020. For not to have a 10% penalty from our 401k or simple, is it too late this year to withdraw and pay it back within 3 years?
No, we haven't heard of any extension on that. So if you had because again, that is just you taking a kind of a loan from your 401k. It's because people who have needs, they have let go the 10% penalty and you could pay it back. But I have not heard of any extension for 2021. So if you didn't do it that time, I would not initiate anything before you learn more about it. I don't think that is in place as of right now. If you have already borrowed, you have that timeline, you can still pay back within 3 years, but not new that I've heard of anything.
Great. Awesome.
Again, no other questions? I'm surprised. With that 124 people on the call, we still have some time. We can take it. Go ahead. Ask questions. I'm here.
I think we are at a good stopping point for now. But again, Roshan, wanted to thank you again for your continuous dedication and all the great information that you've given us today, for your insight and your expertise. So thank you again for your time today.